Okay, so we are back discussing how to use the accounting equation to record a company's different types of business transaction. On this example, again, we said that the company borrowed $400,000 in cash from a creditor. So the accounts involved would be cash as well as your liabilities. And now we have something called notes payable. Notes payable mean that you sign what's called a promissory note, a written agreement to pay back the amount that you borrowed plus interest at some point in time in the future. So if you have student loans, you sign a promissory note. For your car loan, you sign a promissory note. For your mortgage, you sign a promissory note. Okay? Let's look at some more transactions. In this next transaction, we paid $5,000 cash to purchase land. So notice for this activity, it's called an asset exchange. We're exchanging one asset cash for the other asset known as land. How is that possible? I'm glad you asked that question. Well, one asset account, land, increased by $500,000, and the other asset, cash, is going to decrease by $500,000. Notice that it doesn't impact the other side of the account equation because the two asset accounts are going to offset one another in this transaction. Want some more? All right. Next, we obtained $85,000 by leasing campsites to customers. So now we're actually going to earn revenue in this transaction. We earn revenue by leasing campsites to customers, and those clients paid us $85,000. So now our cash account would increase by $85,000. Retained earnings is going to increase by $85,000. It increased because we earned what's known as revenue. Revenue is an increase in assets that has to be earned either from providing a service or selling a product to your different customers. So again, we earn 85,000 by leasing campsites to the customers, increase to the cash account, and increase to retained earnings. Okay? So again, the revenue, when there's an increase in revenue, that's going to increase your retained earnings. Next, we paid $50,000 cash for operating expenses such as salaries, rent, and interest. Now, I got to sneeze. Excuse me. Sorry about that. Okay. You heard the phrase, in order to make some money, you got to do what? You got to spend some money. So those are known as expenses. Expenses are an outflow of cash that are going to result in effort to earn revenue for the business organization. So yes, we're going to lease out campsites, do things of that nature, but we got to pay our employees. We may have to pay rent, insurance, interest. Those are known as expenses. So think about, how do expenses impact your retained earnings? Well, expenses are going to decrease retained earnings. And because you're spending money, your cash account is also going to decrease. So notice again that every transaction still must be in balance. For this case, assets decrease by 50,000, retained earnings decrease by 50,000. Having fun yet? All right. Next transaction, we pay 4,000 in cash dividends to its owners. So again, dividends refer to an outflow of cash. This is money being paid to the stockholders of the business organization. So when the money was paid out, your cash account decreased by $4,000. Your retained earnings account decreased by 4,000. So just like expenses, dividends will also decrease retained earnings because these refer to money going away from the company either for expenses or for payments made to the stockholders of the business. The more you practice record these transactions, the better you will understand how to use the accounting equation. Okay? Next up, we talk about something called the historical cost concept. Let's assume this is your property. You purchased a house for $500,000. Okay? You had the property appraised, has a market value of $525,000. Well, accounting is very conservative. We have what's called the historical cost concept, which simply says require that most assets be recorded at the amount paid for them, their historical cost, not their market value. And why is that? Well, it's because market values tend to fluctuate. It could be 525 this year, it might be 510 the next year, or it could be 575. It's going to fluctuate. But what is true and consistent is the amount you pay for it. So what accounting says is that record your assets at historical cost. Now, if you sell them at a higher amount, it's at that point in time we'll recognize the market value at that time. So the historical cost concept says record your assets at the price you pay for them. Okay? Let's take a look at a summary of all those transactions we looked at from transaction 1 through 7. All right? To look at the big picture. So here we're showing all of those transactions. So now this is your, remember we said what accounting does, it records information by putting it into appropriate categories. The categories are assets, liabilities, and stockholders' equity. So at the end of the accounting period, which again might be a week, it could be a month, it could be quarterly, our cash balance is $51,000. We have land that has a value of $500,000. Again, that's what we paid for it. Those are your assets. So you would add those two together, the cash plus the land, your assets total $551,000. Now remember, the other side of the accounting equation must also equal that 551. So let's check. We have notes payable liability. We still owe our creditors $400,000. We have common stock for $120,000. And for retained earnings, it increased $85,000 from revenue, decreased $50,000 for paying expenses, and for the $4,000 for dividends, retained earnings is $31,000. So add these three together, notes payable plus comes out retained earnings. Therefore, the right-hand side of the account equation also equals $551,000. Your account equation must always be in balance. Your assets must equal your liabilities plus stockholders' equity. Okay? So remember that retained earning does not represent the amount of cash on hand, but it does limit the amount that we can pay to dividends based upon the cash available. For example, look at this account equation. We got cash for 400, land 1900. So assets total 2300, liabilities 700, common stock 1000, retained earnings 600. So in this case, if we want to pay out dividends to the stockholders, we can't pay them in dividends more than what we have in cash. So the max we can pay out in dividends to the stockholders based on this equation would be $400. Okay? What happens if a company has to liquidate because they do not have the ability to meet their obligations as those obligations become due? With this account equation, take a look at it. We have assets 225, common stock 200,000, liabilities 100, and retained earning is negative, which means that our expenses have been more than our revenue. So in the case of a liquidation, when a company decides to sell all their assets to pay the creditors, then the creditors have a priority before any investors. So that means that this 200 will be paid to the creditors before any funds are paid to the investors. So notice that we only have an assets 225, right? So once we pay our creditors, there's only $25 to pay to the investors, which means that as an investor, you're not going to get the full amount owed because of this liquidation. Okay? Business liquidation results from the mismanagement of assets. So in this case, take a look again. We got cash $50, land $950, that's $1,000, liabilities $300, common stock $500, retained earnings $200. When you take a look at social media and you see people showing all of their assets, what you don't know is how much do they have in liabilities. So in this case, notice that we owe $300. However, we only have in cash $50. So if all those debts became due at the same time, how are you gonna pay it? So what we're saying here is that companies have to liquidate because of mismanagement of assets. Be wise, people. Do not allow people on social media to give you the impression that they have all of these assets, but ask them, how much do you have in liabilities? Okay. There's a accounting principle called the going concern doctrine, which assumes that a business is able to continue into the foreseeable future. So in this case, if we get to a point where we cannot pay all of our debts as the debt becomes due, we become what's called insolvent. Insolvency is often followed by bankruptcy. Okay? So if a company's going concern status becomes uncertain, accountants are required to notify creditors and investors. So if we see that a company is not able to meet their obligations as an accountant, our job is to notify the creditors of that company about this status as well as the investors of that company. Okay? So once we've done all of this work, you recorded all of those transactions for the accounting period, you summarize the information, we then prepare something known as financial statements. These are reports prepared on a periodic basis that would tell us certain information about that company. There's a statement called the income statement, statement changes in stockholders' equity, and a balance sheet. So let's take a look at these different types of financial statements. Okay, so these statements are going to be presented to external users, those outside of the business organization. So each account, again, remember we're going to keep track of the balance of each of those accounts. They each have what's called a ledger account. So there's a cash ledger account, there's a land ledger account, etc. And the ledger shows what is the current balance in each of those accounts. We're going to use that information to prepare our different types of financial statements. So you ready? Are you sure? Okay. Well, stay tuned for the conclusion of our chapter 1 video.